All right, good morning. We are right at the top of the hour, so we are going to go ahead and get started. Today is Thursday, April 21st, 2022. Welcome to this month's Capital Markets Update and Outlook Call. Today, we're going to hear from our Chief Investment Officer, Tom Fox. Tom will review the positives in the markets, headwinds, and give us his outlook for the rest of this year, 2022. Ultimately, this is your opportunity to kind of look over our shoulder and get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions, to put them in the chat box, and I'll be sure to bring them up with Tom here for you today. If you are new here, my name is Eric Hagen. I'm president of Capital Consulting Group, or CCG. CCG consists of myself, Chief Investment Officer Tom Fox, again, who you will hear from in a few minutes, financial advisors Dan Oshman and Rana Grant. If you are a guest of Dan or Rana today, a special welcome to you. And then we have client support John Knutson and Marilyn Westmark. Together, we steward long-term relationships with our clients and work only for our clients. We can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. If you'd like to learn more about this, you can go to clearfinancialfuture.com and watch a short 2-minute video. And we give our clients' life savings the attention it deserves with our Smart Mix portfolio solution. Smart Mix is our personalized portfolio solution for individual investors. Whether you have $25,000 or $25 million, Smart Mix is our process for helping you get and stay invested right. If you'd like to learn more about this and to see how we're doing with recent performance updates, you can go to smartmixportfolios.com. All right, before we get started, tax time just ended, which means now is a great time to be thinking about important financial decisions that you may have to make this year. And we want you to be educated. We want you to be in the know. So after today's message, I encourage you to go take a look at our website. We've got a very, very full calendar coming up. We've got Savvy Social Security Planning for Women next week. If you're single, divorced, widowed, you need to be on this presentation. We've got Savvy IRA Planning the week after that. This is specifically for baby boomers. We've got in May, we've got 6 retirement account options that every retiree needs to know. This is if you still have money in a retirement plan at work. What are your options of what you do with that money at retirement? That's a great, very in-depth presentation there. And then May 19th, we have our next monthly capital markets update call, as we're doing here today. End of May, we've got Life After Work, how to create a good life in retirement. Moving on into June, we talk about some legacy planning. We've got 6 steps to legacy planning for the generations. Later on after that, we've got how to plan, communicate, and execute the smooth transfer of assets and values from one generation to the next. And then we've got our June capital markets update and outlook call. And then later on in June, we've got some cybersecurity presentations coming up. So we've got one called Hack Proof Your Smartphone. So if you have a smartphone, you definitely want to be on that call. And then end of June, we've got 1 hour to savvy cybersecurity. So again, very, very packed calendar. Be sure after today's message to head on over to the website, take a look, and RSVP today for those events that you want to be on so that you get those reminders. In addition, throughout the month of May, you can bring your unwanted and unneeded documents to our office, and we will take care of shredding them for you. So that's just another week or 2 away. You know, protecting our personal information online is a given. We are all familiar with that, but sometimes it's easy to forget that the threat of paper identity theft is still very, very real. And we understand how much paper you get from us, and we'd like to help you out and help protect you. And inevitably, we get asked, what can I shred and what should I keep? Well, if you don't know what documents to keep and what documents you can toss, we put together a handy keep it or toss it guide that you can also get on our website. I'm going to go and put a link to that in the chat box right now. Bear with me here just a second. So here's a link right to that. So if you want to go grab that later on after today's message, I encourage you to do that. It's a great tool to use and refer to as you're going through different documents and preparing to bring us stuff to shred. So Start putting together that shred file. Feel free to bring it by our office anytime during the month of May, during obviously regular business hours. We're open 8:30 to 4:30 every day. And just drop it off and we will handle the shredding for you. Looking out a little bit further, as you know, we do today's capital markets update and outlook call every month. And we look forward to being here with you online next month in May and then the following month in June. But for July's presentation, mark your calendar because we will be live at Oak Ridge Country Club for a special halftime report luncheon. The plan right now is that this presentation will start at 11 o'clock as we are today, and then we'll have lunch to follow. So we hope that you can make that. Mark your calendar, more details will follow today's announcement. Then in August, for those of you who are existing clients, please save the date for the evening of August 25th. After 2 years off due to COVID, we are so excited to be back on Lake Minnetonka for our annual client appreciation event. I cannot tell you how much we are all looking forward to this. So mark your calendar, save the date, and watch for a more formal invitation. All right, so with that, I'm going to turn it over to Tom. Again, Tom is our Chief Investment Officer. He spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. And he has an impressive long resume, as you can see on the screen. As always, I'm very excited to have him here today. And again, as you're listening to Tom, please feel free to ask any questions in the chat box. I will be watching that chat box, and I'll present those questions to Tom for you. I'm reminded when I was a child, a younger kid in school, a student, the teacher would always remind us, guys, if you have a question, if you're thinking about a question, raise your hand because 20 out of the other 30 kids in the class probably have the same question. So if you have a question here today, please raise your hand, put that question in the chat box. We would love to address it for you. If you are watching this in the replay, please feel free to email us directly, email me directly with any questions that you have. We would love to circle back with you with anything that comes up. So with that, I will turn it over to you, Tom. Tom, thanks so much for being here today.
Thank you, Eric. Hello, everybody. It's good to be back and to discuss the markets and the economy. We're in very interesting times, and I think you'll get a clearer picture of what we're thinking as we go through this presentation today. If you remember back in December of 21, we said that the first half of this year, 22, was going to be rough, and that we expected the markets to drop over 10%. We said there would not be a bear market, but we expected there would be a definite correction. Well, that's taken place, and so we were pretty accurate on that. Also in December, we said we are looking to transition to a great second half of 22. And we're still holding to that. All our weight of evidence is pointing to that. So we'll go through positives, and we're going to go through the headwinds and the wall of worry, the markets climb. But I would say that we've titled this over the last several economic outlooks, the year of transition. Well, I'm adding a word now for this one, baked in. So you'll know what I mean by that. So we got transition and baked in, and this is not a cake, but you'll see what I'm talking about. So here's the current market positives. Inflation is showing some signs of maybe rolling over, and we'll look at some charts on that. Some components are starting to come down. This is all good news. So what are we saying? We think inflation is probably peaking right now, and that we're going to see it begin to diminish slowly, but as we go through the rest of the year. And here's the baked in, is that most investors' views of the stock market economy are overly bearish. There is so much bad news out there that is indicating to us that we're probably at a market bottom. Whenever you get over bearish, when you have so many negative reports and negative commentary on the cable TV and the financial news, that typically is a sign that we may be approaching the bottom. Remember, markets don't bottom on good news. They bottom on bad news. So much of the bad news is already priced in the stocks. Another positive is households are in fantastic financial shape, and they're ready to move into driving the service sector, which has lagged. Most people have been buying big items, and now they're going to start spending their money on vacations and flying and all types of things in the service sector. So we expect that to begin to rise, and that will help the economy. Also, because of the correction and the markets come down, and yet earnings are still going up, the market valuation is no longer way overpriced. So it's still high, but it's not what it was before. So we think there's more room to go up in the price to earnings ratio or the valuation. The last thing that's positive, we do not see any recession in our view. Now, a lot of economists are predicting a recession, and there could be a recession in Europe and some of those parts of the world where they're dependent on Russia oil or other energy related items that are now in trouble. But the US is different. Our economy is looking very good. So there is going to be a slowdown in the global economy, but we think the US is going to remain very positive. So no recession in the US. Okay, here's the baked in, priced in wall of worry. Investors are way too bearish. That's what we believe. And they're pretty obvious. Inflationary pressures remain. Supply chain shortages are still around. We think it's going to get better. China COVID-19 strategy and surge is maybe out of control. And they've been really hard-lined on that. I wouldn't want to live in China right now. And then you have the Russia-Ukraine war rages on, Putin's not giving up. And then a very hawkish Fed. We're expecting 0.5% in May for the interest rate increase, and then they'll continue to raise rates. However, we do not think that they will go as far as the market's discounting already. And then there's just the general skepticism of trading community. Haven't seen so much bearishness. Again, markets don't bottom on good news, they bottom on bad news. And if you look at the American Association of Individual Investors, the AAII, they take a look at investors' survey on how many people are bullish, and that's at an all-time low. Typically, that has been a great contrarian indicator, meaning that it usually marks a bottom. Here's another one. Here's the more sophisticated institutional hedge funds. How many are long stocks versus short? Well, their long stock portfolio is at the lowest level since 2020, according to Goldman Sachs. So what does this mean? Even the institutions have been bearish. Again, markets bottom on bad news. Well, this is a whole list of a wall of worries, which tells us that the market has already discounted this, and any positive surprise will cause the market to go up. Now, here's a survey of the top fears of investors. And you can see the fourth one down, the Russia-Ukraine conflict was the highest in March, but look at how far it's dropped in terms of worries. And what's gone up? Global recession, not US, but overseas, hawkish central banks. And so those are the two top worries of investors, or the biggest tail risk of maybe a market that would go into a bear market, which we do not believe was going to happen. We talked about the AI individual investor bullish sentiment from 1987 to present. You can see that red line. We're touching where we did back on 9/3/92, which kicked off a major bull market. We're there. This is a great contrarian indicator. So we're thinking that people are so bearish, even the retail investors are so bearish, that this is a good time to probably put some money to work, because we think the markets are going to move higher. It will be bumpy, and we'll talk about that. Another is the global growth optimism. That's at an all-time low. That's typically bullish. You can see the points, 98, in 2006 and July 8 and 19. These marked bottoms in the market, and then they began to rally. Well, we're right there. In fact, we're at a probably record low here. So the optimism is at an all-time low. Again, a contrarian indicator telling us that much of the bad news is already baked into the stock market. No recession. Here's industrial production manufacturing. You can see it's heading up, and the economy, based on all that we're seeing, is still robust in the US. And so we're expecting that to continue to rise. So we do not see any recession in the US. I know there are a lot of economists and others that have raised their expectation, but they're only in the 35, 40% chance or probability, still not over 50. So we are in the camp that there is not going to be a recession this year. We'll look at next year and next year. But right now, no recession, economy still looks strong. Okay, so the last several days, there was a turn in the stock market. Why is it going up? Well, if you look at the red line, raise cash for tax day, we had a record tax payments. It's estimated that Americans paid $800 billion in taxes and $150 billion in crypto gains. This is a huge number. It's a record number. The government's going to get a lot of money, but people had to raise money by selling stocks. Soon as that day, the tax day hit, what happened? Boom, it started going up. And typically, you will see for the next 3 months, maybe a 2.5% to 6% gain after a big tax day. Last time we had this kind of a tax day was 2012, and the market rallied after the tax day. We're seeing that happen right now. Okay, so what about April to June? This again, the year of transition, and I had baked in April through June. Bad news is already baked in the stock market. We've been talking about that. We think we've already seen the market low on February 24th, where it dropped around 12 to 13% in the S&P, which we called back in December of last year. Also, Ukraine remains a thorn in Russia's side. We don't see a Russia victory coming. We could be wrong on that, but we think Ukraine is going to be a thorn in Russia's side. Also, so far, the first quarter corporate earnings are coming in above trend. This is good news. That means that the earnings are going up. They're beating expectation. So there's a lot of good news on the earnings front. That's another reason why the stock market's been moving up the last several days. You can see that Tesla came out with record profits, record revenues, even with all the supply restraint and all that. So just Tesla is an example of a company that figured it out, and they had record everything, great earnings and revenues. Now, family households begin to spend their abundance of savings. You got to remember that the US household is in fantastic shape. Their house is worth more. They've been saving in 2021 for 2 years. So their cash positions and their liquidity has risen. Well, what are they going to do with that money? They're going to begin to spend it. That's all good for the companies, good for the economy. So we think it's a very bullish indicator. Now, do we think it's all smooth sailing from here? No, we don't. We think that the stock market's going to remain bumpy, but the overall direction will be up. We'll have some 2 steps forward, 1 back. And of course, the wild horse is Russia. If they were to do something unexpected or go to World War III, that would be a geopolitical event. And you can't predict geopolitical events. You never know when they're going to occur. So right now, we think it's a low probability that Russia gets into a worse situation or drags in NATO. We do not think that's going to happen. I don't think they want to take on NATO right now. They're struggling with just taking on Ukraine. All right, here comes that transition, the second half. Fed raises rates less than expected. We do expect a 0.5 point in May, and they will continue to raise rates, but we're not looking at 7 or 8 interest rate hikes. We think they're not gonna do that. That's what's discounted in the market. That's another reason for that we're bullish on the market. And we also think that the VIX, or the stock market volatility, is going to start to decline. We've already seen that. We think supply chains are going to begin slowly to normalize. And we predicted that early in the year. And we think everything is in line for that. We also think oil prices will begin to go under $100, and then inflation decrease slowly. And we've already started seeing some signs. Corporate earnings and revenues remain above trend into the second half. The economy accelerates, consumers begin to spend big. And remember, we showed a chart a few months ago that when you have midterm election, the first half of a midterm, the market is pretty flat. The average return for the second half when you have a midterm election is around 13%. So we could have a bull wind in our sail just from the midterm election. That's based on history. And so we originally said 5,300, but with the Russia war in Ukraine, we lowered our year-end target at 5,100. So we're still expecting a positive 6 to 7% for the S&P 500, not what we had last year or the year before, but we are expecting a decent year. And we got to remember where we've come from. Over the last 3 years, you can see it highlighted in the market was average 20+% the past 3 years. In fact, it's been up on average 14% since 2009. So we've been having a very, very good stock market. Another good year? Yes, we think so. We think that -6, -5 where we are today is going to end up in the positive somewhere around that 6 to 7%. So we're looking for one more year. Now we're not going to forecast 23. When we get closer and have more information, we'll make a decision on that. Now right now the investors there's a 91% probability of a Fed hike, not of 25 basis points, but a 0.5%. Should be a 0.5. Now I forgot the decimal there in May. And so that is on there. And that's what we're expecting for this next May Fed hike. And they're going to begin to pull back on their mortgage purchases and treasury purchases. So all of that has begun to be discounted in bonds. Bonds have already predicted this rate hike, and they've been demolished. And we'll talk more about that. We'll look at some charts. Now, the long term, this came from BlackRock, one of the largest money managers in the world. They're looking at increases in the long term that don't look so bad based on historical numbers back to 92. So they're maybe going to raise rates to a little over 2%, maybe close to 3%, but they do not see them going much higher than that. And that's sort of our scenario, that they're not going to raise rates as much as most expect, which will be bullish for the stock market. Now, here's some of the good news on inflation. You can see the month over month change in the core CPI. It has rolled over a little bit. This may be a sign that inflation is peaking and may begin to roll over. And that's what we're hoping for. We do think it's going to start coming down. The next chart will give us some more indication of that. 1/3 of last year's CPI gain last year was used cars. I don't know if you've been in the used car market, new car market, because of the supply constraints, prices, which made up a big part of the CPI gain. 33% of the CPI number was cars, used cars. But look at the chart. It is rolling over. Car prices and their contribution to CPI is coming down. This is good news for the inflation rate because it's a big part of the inflation rate, especially in 21. So we're starting to see signs inflation has peaked and starting to roll over. Now let's talk about global bonds, because a typical advisor would have like a 60-40 portfolio or a 70-30, and they would have 30 to 40% in fixed income. And that has been historically a great place to be when rates have been coming down over the long term. However, back in 21, early 21 spring, we began to eliminate all our fixed income and move it to alternatives. Now, alternatives are a different way to obtain a return that's similar in volatility to a bond, but is not interest rate dependent. This has been a fantastic move. And you'll see in the next page, you can see how the bond market's been crushed by 10% globally. And here is the, I guess we could move our picture a little bit. You can't see the aggregate, but it's around close to 8.8, 8.9, 12% down for the year. I mean, 8%. I just looked and I think it's 8.9% minus for the year. In other words, if you had bonds, that portion of your portfolio it's a little higher than that. That was through last week. It went down more, got hit harder. But look at US corporates. What if you were invested in corporate bonds? You'd be down over 11%. Municipals are down 7.5%, high yield down 0.65. So the whole fixed income market has been destroyed. This is one of the worst bond bear markets in history. Now, because of our strategy of moving from fixed income to alternatives, our portfolio is up around 2.5% because we were able to navigate out of the fixed income. We could see the rates where they were going to go. So we began to empty our portfolios of fixed income. And we've had really good returns because some of the alternatives we've been in have done really well. So we are now kind of offering a 60-40, but it's a new 40. It's the new way of managing money. Now, what does this mean? We will go back to fixed income. Down the road, when we feel interest rates have peaked, we're probably going to start going back to some fixed income holdings, but we have done really well by avoiding them completely. Now, here's something that's going on. Mortgage rates now over 5%. I hope if you're in for a new house or refinance, everybody already did that because now the rates are heading over 5%. We do think housing will slow, but because of the low inventory, we believe housing will be safe because there's just no properties, which will keep the price high. So we don't see a big fall off in housing prices. But I'll tell you what, it's going to be tough for real estate agents because they just don't have any inventory. And now they got to deal with a 5%. But because the inventory is so low, housing is safe for now. All right, here's our COVID. You can see hospitalization and deaths are in full retreat. This is all good news. And this was updated not that long ago. So you can see we had all those major peaks and now everything is going in the right direction. And that brings us to our next chart, which may have to be thrown out depending on what the CDC does. Airlines ditch face mask rules for the first time. Yahoo. I'm going overseas next week. I was not looking forward to 16 hours or more at airport time, 20 hours of wearing a mask. Hopefully they don't overrule it again, but you heard probably in the news that the CDC is going to fight the judge in Florida who threw out the mask. Everybody's rejoicing. I know some people are fearful, but hey, you're free to wear a mask or not wear a mask. I'm hoping this sticks for my whole trip. I don't want to wear a mask. Anyway, that's my outlook. Thank you for being a part of Capital Consulting Group and working with Eric. And we try to do our best to look at the markets and the economy and where it's going.
Thank you very much, Tom. I'm with you. I flew just a short flight not long ago with a mask on. I don't know how we could do it with you flying overseas. So I'm glad that this is lifted. I hope it sticks for you.
Thank you very much.
Yeah, with that, if there's any questions, I'm looking at the chat box here. It looks like I didn't post that link to that guide correctly. So let me go ahead and fix that. But if you have any questions about Tom's message here today, about what he presented, no matter what it is, please feel free to put that in the chat box right here. Right now, if you are watching this in the recording, please feel free to email me directly. Reach out to us. There's forms on the website. You can put questions in, what have you, but we'd love to address and answer any questions that you've had. I have had a number of conversations with people in the last week or so. A lot of concern, a lot of fear, a lot of worry, and hopefully Tom's message here today helps you understand where we're at in the stock market cycle, where things are going, and what the expectations are moving forward. So hopefully that provided some comfort here for you today. And then lastly, today's presentation is being recorded, so you can always go back and watch it on the website as well. And then for those of you who are live with us here today, I do have a summary of Tom's message in a kind of a short 2-page flyer that I will send out to you by way of email. If you're watching this in the recording, there should be a link below this video that you can download that summary as well. I'll try to have that up here in the next couple of hours for everybody. So just a couple more housekeeping items while I do that. Again, if you have any questions, please put in the chat box and I will get those to Tom here. The one housekeeping item here, just a reminder, if you want to kind of touch base on a more regular basis than once a month, I do go live on YouTube and Facebook every Monday morning with a kind of a brief 3 to 5 minute economic update, kind of summarizing what we're seeing, some nuggets that we're watching for. After years of pre-recording this video, again, I am doing it live now. So you can go to the Facebook page, you can go to the YouTube page, like it, follow it, turn on notifications, all of that. And then later on in the day on Monday, I send out an email with a link to that recording. So if you're not getting that weekly email, please go to our website, investwithccg.com, and subscribe to that. We will not fill your email box with emails. I send out one email. It's generally around 3 o'clock on Monday afternoon with links to everything for the week. So next Monday, I'll do the link to the Monday morning update, but I'll also have a link to the recording of today's message, to the summary, to some of the events that are coming up. Remember, we've got that very robust calendar with tax time now behind us, summer quickly approaching. The next couple of months here is a great time to address any important financial decisions that you have for the year. So I encourage you all to tune in, pay attention to any of those messages that would be of value to you so that we can have a meaningful discussion and really help you make your next financial decision and the one after that a good one. Again, you can find all of this at investwithccg.com. So one final chance here, nothing in the chat box. Tom, that means you did a great job as always. Thank you so much.
Thank you, Eric.
Any parting words?
It's baked in.
It's baked in. I love it.
Bad news is already baked in. Any surprise that's not as bad as expected will be bullish for stocks.
Awesome. Well, as always, Tom, thank you so much. And that concludes today's call. We will look for you in upcoming events, and we wish you all a wonderful rest of your day. See y'all soon. Bye now.
Thank you, Eric. Bye.